All right, and we are here again with the next guest, and I'd like to invite Dr. Ravi Chamria to the stage. Hello, how are you?
Yeah, hi, Alec.
Really happy to see you again and again on our conferences throughout the years. I think it's been 2 or 3 times in a row. And just for the new audience, we've been doing some kind of DeFi series on our community page. And if you are interested in learning all the DeFi foundations, we have some kind of amazing 4 webinars with Dr. Ravi Chamria. And this time we are here to speak about the tokenized deposits, the next evolution of bank money. And yeah, without further ado, I'll be short in the introduction, and the stage is yours. Good luck to you. Let's make sure that your deck is on the screen. Just a moment, please. Yeah, and you are good to start. Thank you so much.
Right, thank you. Thanks, Alec. Yeah, hi, everyone. My name is Ravi. I'm the co-founder CEO of Z. And today we are talking about one of the most interesting topic in the blockchain space, which is tokenized deposits. So I think blockchain has already proved the value of stablecoin. Stablecoin has become the most established use case in recent years, and especially in last 2 years, with a lot of favorable regulatory changes, I think we are seeing massive volumes that are happening. And stable coins are not just touching the payments use case, but they are being used in various creative, innovative use cases, solving this clear pain point which has been there, which is trapped liquidity or inefficiency of the collaterals, delays in payments as well as settlements, and that gives light to liquidity challenges and settlement risk. So these have been pain points which stablecoin has addressed. But then why tokenized deposits have suddenly become such a blazing topic today in the banking space? And the reason is very clear, because these pain points which stablecoin has been trying to solve has been there in the traditional financial infrastructure. And that's where tokenized deposits come into picture. Tokenized deposits are a way where bank can use their existing deposit relationship and create programmable digital money. So tokenized deposits, one, the massive demand is being created as we are seeing a massive surge in the tokenization of assets in this space. But the challenge with tokenization of assets is that even if the asset lifecycle has been tokenized, the payment leg is still done using the traditional infrastructure. So that basically puts a break into the entire workflow. Stablecoins have already proved demand for on-chain settlement. So that means it's very clear whether it be customers, retailers, wholesalers, or large organizations, people are very, very seriously looking at on-chain settlement. And seeing this kind of surge in the usage of stablecoins, banks, of course, need their own regulated version. And that's where we come to tokenized deposit. So what exactly is a tokenized deposit? So you have a banking relationship, you have deposits within your bank account, and bank is handling that relationship. So if you take that deposit, the fiat deposit, and tokenize it, then it's called a tokenized deposit. So it's a normal bank deposit, which is represented on an online ledger as a token. Very similar to the way we see stablecoins today. But in this case, it is more within the regulated banking premises. So it is issued by a licensed bank or a depository institution. It represents a deposit claim, which is against the issuing bank. It is redeemable against traditional deposits one-to-one. So if you hold $1,000 in your bank account, that is equivalent to 1,000 deposit tokens. And then it remains within the regulated banking parameter. So that is how typically tokenized deposits differ from stable coins in terms of who is issuing. And I'll come to that in more detail. But essentially, when we talk about the programmable nature of the token, which are created on blockchain, or composability, the smart contract features where you can embed different logic related to compliances, etc. all those features become part of the tokenized deposit. So one of the major motivation for banks to do tokenized deposit is because stablecoin has already taken a large market share in terms of on-chain money. And if you see the way stablecoins work today, so let's say you want to buy stablecoin, and so you take out $1,000 from your bank account and you buy stablecoin, and stablecoin issuer issues 1,000 stablecoins to you, which are backed one to one with the US dollar. Now, what's the stablecoin issuer does with that money, with that fiat? Most of it today is getting into some short-term deposits like buying US Treasury. Now, when they do that, that means that most of that money is now off the balance sheet of the bank, and bank retains only a small portion of that. Now, this is just for illustration. It is right now showing that 85% goes into US Treasury. That percentage may change, but the idea is that still a chunk of money is getting outside the banking channel. And banks definitely would like to retain most of the deposits because, as we know, the whole banking model works on the deposit relationship. The money that they have from the customers can be used for lending and earning spread on that. So vis-a-vis a stablecoin model, if you look at the tokenized deposit model, since banks are tokenized the existing deposits of the customers, all the money still get retained within the bank balance sheet. So that is how the two models differ, and it is clear that banks want to invest into tokenized deposit model. So essentially, if we try to see what are the major differences, so stable coins typically are issued by a non-bank or a specialty purpose vehicle issuer, and we know quite a few popular stable coins today like USDT by Tether or USDC by Circle. Vis-a-vis tokenized deposits are issued by licensed bank, and today there are quite a few initiatives which are already there in the public domain. JP Morgan has got a big initiative on tokenized deposits, initially as part of the Kinexys network, but then now they have formed a consortium where a lot of other banks have joined in. Citi, recently BIS Agora project is again a very big initiative where they are not just dealing with tokenized deposits, but also bringing centrally bank issued digital currency called CBDCs. Now, in terms of holders' claim, in the case of stablecoins, the claim is on the issuer or the reserve structure. But if you see the tokenized deposits, the deposit claim is on the bank, the way you have claim on your regular fiat deposits. Best Fit stablecoin has proved to be very, very successful in the open crypto native decentralized networks or settlements. And I think it will continue to do so. Tokenized deposits will be are more, the focus has been on institutional regulated settlement. And we'll talk about some of the use cases that banks are looking at. But it's more about wherever the transaction needs to happen, payments and settlement needs to happen within a regulated environment. That is where this comes into picture. Bank impact, stable coins definitely can move deposits out of bank, as we saw on the previous slide. Tokenized deposits keep deposits within the banks. Compliance model, in the case of stable coins, it may vary from issuer as well as jurisdiction, depending on where the issuer sits and which kind of jurisdiction they follows. In the case of tokenized deposit, it is bank grade controls. Again, it will vary by jurisdiction because banks may have different controls and compliance policies depending on which jurisdiction they are from. But it follows the bank grade and whatever central bank of that jurisdiction has, whatever rules they have designed. So here the debate is not about these two. There are a few other forms of digital money like CBDCs, which are issued by the central banks, or we have money market funds. So the way we see it is tokenized deposits are again going to become quite big because there are some very strong use cases where it makes a lot of sense for banks to invest into tokenized deposits. But essentially, as happens today also, we have different flavors of money. Similarly, we believe that stablecoin and tokenized deposit will coexist. Um, there is an overlap in some of the use cases, but largely stable coins are super powerful when we talk about open network settlements. So if you talk about any decentralized network like DeFi or any other areas, for example, deepen networks, etc., stable coins are still going to be very powerful and will continue to thrive there. Tokenized deposits are more suitable where we talk about regulatory bank money. For example, corporate transfers, cross border remittances through a regulated bank rail or settlement systems. There, tokenized deposits will have a larger play. So, if you talk about some of the use cases of tokenized deposits, um, first and foremost is institutional treasury settlement, where corporate treasury funds between entities, and especially when it's cross border. Then, and I'll take a use case detail. Today, the process is highly broken, inefficient. Time is not the major challenge. The challenge is about the back-end cost, the number of intermediaries involved, etc. Cross-border corporate payments. Then atomic DVP, a settlement for tokenized assets. This is something which is going to pick up big time as we are going to see more and more assets being tokenized. So as I mentioned previously, in the case of tokenized assets, the payment leg becomes very important to have a full-fledged on-chain transaction. Because until unless we have a full-fledged workflow on the on-chain, the basic tenet of blockchain, where settlement and payments can happen at the same time, does not get realized. So I think it becomes very important to settle the asset and the cash leg together. So when we talk about securities being tokenized or tokenized funds or any kind of even physical assets in future. Then intraday liquidity and collateral movement is something where most of the pilots have been done. This use case is very clear. So all the wholesale use cases where transactions between banks, transaction between banks and the central banks, etc., it makes tokenized deposits a very interesting use case. So, taking one use case in detail about a cross-border payment. So, just imagine a corporate which is transferring payment from one country to another. So, here on the left-hand side, you can see how the process works today. So, there's a corporate treasury, goes to the treasury bank. There are correspondent bank gets involved when we talk about cross-border payments. There's a receiving bank and then overseas supplier. And in this whole process, there are multiple intermediaries. Correspondent bank may be one or two, depending on which countries are the transaction happens between. So there are multiple intermediaries. There are sequential messaging, and that's take time because until unless the first leg of the transaction is done, the second leg can't start. And each and every point, the transaction parties, the transaction amount, and different compliances need to be adhered to. Then it leads to trapping of liquidity until unless the settlement happens, the liquidity is frozen at whichever intermediary the liquidity is there. And then the settlement is detailed. We have seen cross-border remittances may take from 1 or 2 days between some countries to even 5 days and going up to 2 to 3 weeks. And there are a lot of charges that FX conversion, reconciliation. So a lot of backend operations are there which are highly efficient and lead to additional cost of remittances. With tokenized deposits, the process becomes very seamless. Most of the backend functions, like for example, the logic of FX and payments, can be embedded into the smart contract. The logic of compliances for both the countries can be embedded into the contract. Adding desired privacy also takes care of all the privacy controls that need to be there, like taking care of the disclosure or non-disclosure of the transacting parties, what kind of transaction amount is being done can happen. So here, if you see, since the payments and settlements are happening pretty much at the same time, it releases the liquidity which typically is trapped in the existing traditional finance system. And the transaction becomes much faster. There are very less fewer intermediaries, leading to faster settlement, at the same time lower cost of managing the infrastructure for cross-border remittances. So it's a very clear, and I think stablecoin has already shown this, and that's why stablecoins are being used for payments in businesses, whether it be salary payments, loyalties, and various other use cases. And I think when we talk about larger transactions within the corporates, B2B payments, I think tokenized deposits will inherit all the value that we have seen in the case of stable coins using blockchain technology. So now coming to, we have talked about what tokenized deposits are, what value it plays for a bank, and how it reduces cost, efficiency, plus a better customer satisfaction. Now, how can banks implement tokenized deposits? So there are various modalities different banks have approached. One is bank-owned custom chain. So most of the banks who have started initiative create their own custom chain because they require full control over issuance or privacy or compliances, different kind of integrations, and it creates a solid value differentiator for a bank. The major trade-off in this case is they need to have interoperability because end of the day, once you have tokenized the deposits, you need to have a clear interoperability network so that these tokenized deposits can then be scaled into larger and larger adoption. The second approach is consortium network, where a lot of consortium have already started. As I mentioned, JP Morgan or BIS Agora, where again there's a custom blockchain infrastructure, but it is shared with the consortium partners. In this case, of course, having a clear governance and interoperability among the consortium partners become very straightforward because they are sharing a custom chain with a shared ledger, but then interoperability with other networks still needs to be worked on. So here the trade-off is that they need to have a clear governance and interoperability design from day one. And then third-party institutional networks, we have seen Canton network being one, and there are quite a few other networks that are being. They allow different kind of banking applications like tokenization of assets or tokenized deposits being done on them, and they take care of the privacy and interoperability and other requirements. But in this case, the major trade-off for a bank is that they have a lesser control over the roadmap, the operating model, or even the customer experience. Because when we talk about tokenized deposits, the bank are going to leverage first and foremost their existing customers. So from their perspective, they want to have a bit more control over what kind of data they are exposing on a public chain or a third-party institutional network like Canton. So there are trade-offs, there are benefits, pros and cons of each of the approaches. Now, the second post-implementation comes the scaling challenge, and scaling, the biggest challenge is interoperability, and then we'll also talk about privacy. So these two being the critical factors today, which banks are looking at. Interoperability, again, there are quite a few. So one, as we talked about consortiums like BIS Agora, so they have a shared ledger, and within all the consortium partners have got interoperability. So here the trade-off is that they require governance and legal finality and alignments with different banks, especially when banks are from different jurisdictions. The second approach is coordination layer, where we are seeing players like Swift, which has been providing payment and settlement across borders, for quite some time. So Swift has launched their own network where almost 45 participating banks are there, and then there's a fintech called Partier, which again provides a coordination layer where then you can have your custom chains in whichever format, but then you can use their coordination layer to facilitate interoperability across borders or within the jurisdiction. And then cross-chain connectivity. So these are more of technology tools like Cosmos IBC2. Um, Cosmos IBC2 is a very interesting interoperability platform tool, which earlier IBC1 was largely allowing to interoperate between different Cosmos SDK-based chains. But today with IBC2 now, they have given interoperability with EVM, with Ethereum. And then there is a very interesting roadmap for this year where they are going to provide interop with all the different EVM chains and other ecosystems as well. So, and then, Chainlink has got a CCIP-based styling messaging system, which again provide cross-chain connectivity. So here, Again, privacy, liability, dispute handling, etc., needs to be handled because the interoperability layer is outside the blockchain entire blockchain ecosystem that the bank is investing into. A special mention on privacy, because privacy, when it comes to anything that the bank does, especially when we talk about the heart and soul of a bank, which is payments and settlements. So privacy becomes very important because banks have to adhere to all the compliances and privacy requirements of the jurisdiction that they are operating in. And when in case of blockchain, the privacy becomes even more complex because blockchain per se means that there's a sufficient decentralization needs to be there, but at the same time, privacy means you need to hide everything. So what today, when we talk about privacy in the case of banking use cases, we talk about selective disclosure. So you need privacy from, let's say, two parties are transacting. You do not want a third party to know who are the transacting parties, what kind of transaction amount they have transacted, their wallet balances, etc. So these are areas where privacy needs to be there. But then there needs to be visibility for regulators, for auditors, for compliance teams, risk and operational teams within the bank. So that is where privacy becomes very, very important. At the same time, critical from a design perspective. It needs to have visibility, selective disclosures, and ensure that it adheres to all the jurisdictional requirements. So from pilot to production, what banks need to get right, they need to have a clear strategy and architecture. As we talked about various models of having your own custom chain or creating a consortium or using an institutional chain, to defining the tokenized deposit trail. It's a very simple use case, but in the case of implementation, it does require taking care of all kind of compliance logic, what kind of logic will be inbuilt into the smart contract, uh, the entire workflow of the payment, starting from issuance to redemption, transfer rules, ensuring that the bank balances and the token balances, there should not be any double spending kind of challenges. So, and then integration with the legacy banking systems become very important. Privacy and compliance layer, I've talked in detail, becomes super, super important to design and take care of. And there are various options today. And then once they launch, then production operations, because decentralized networks are not as simple as Web2 systems. So managing 24/7 operations with regular updates, upgrades, and integrations with third parties as well as legacy bank integrations becomes super important. And that's where we have been working for last 2 years with banks and fintechs, helping them navigate this space, see how tokenized deposits can bring an immense value to the bank, and how to get it right in terms of implementing. So, last point, what should CXOs do next? So, one is tokenized deposit, I think, is one of the most talked about use cases today within the banking space. And there are quite a few initiatives that have already there in various phases from pilot to production. So prioritize one high value use case in terms of defining what they want to achieve from tokenized deposit. Whether is it faster settlement, it is lower liquidity friction, or it is reconciliation challenges, or they want to have programmability so that compliance and risk, etc., can be managed. Then they need to define what kind of infrastructure, stack selection, to defining a governance model, whether they will start solo and then interoperate it with other banks, or they will try to form a consortium or be part of an existing consortium. And build the trust framework, because when you take a consortium approach, then trust becomes very important. And at the same time, you need to have a trust framework to adhere to whatever central bank requirements are there in terms of compliances, auditability, privacy, permissions, etc. And then, as we talk to every client, that defining success metrics are super, super important, especially metrics for the pilot. And when going into production, a different kind of matrix, so that the real value of tokenized deposits can be first clearly realized in the pilot stage before getting into full scale production system. So I believe that tokenized deposit, it's not just a technology experiment. You know, it's a new operating model, and I think in the next 3 to 5 years, we are going to see a different sort of transactions that we do with money today. So the way I see it is a digital money will become the new paradigm, and tokenized deposits, along with other forms of digital money, whether it be stable coins or CBDCs or MMFs, will have them, and we'll be using them very regularly without even knowing the complexity which is required to run these systems. So this is what I wanted to cover. If you have any questions, do reach out to me. I'm available on LinkedIn, Twitter, and would be happy to answer any questions you have. Thank you.
All right. And yeah, thank you so much. As always, a great speech, great topic. Thank you for joining us from conference to conference. And that was a really interesting conversation, a really interesting presentation about how stablecoins prove that there is a real demand on this kind of on-chain settlements. And now we are moving to the next step. What happens when banks are bringing this programmability kind of things into the money that they are trying to regulate. And yeah, for the sake of time, we'll be skipping the Q&A session, and we'll be doing the
Sure.
Q&A session in the format of text. So whenever anyone will have any question, they will be just dropping that in the Telegram chat. And I attached the Telegram chat link in the YouTube description and in the comments section. And so, yeah, whenever there will be new questions, I will be asking Dr. Ravi Chamria to cover them in the Telegram chat. And yeah, whenever anyone needs some kind of introduction with our speakers, you can also request that in that chat as well. And yeah, thank you again, Dr. Ravi Chamria. That was a
Thank
really
you.
great conversation, and would be very gratefully expecting you on our next conferences as well. And without further ado, let's move on to the next topic.